Welcome, everybody. My name is Richard C. Wilson, the founder of the Family Office Club. And today we're doing a virtual discussion panel on insights and strategies from successful investment professionals who have raised over $10 million each. The point of today is to share best practices, shine a light on a few members that are doing well and moving quickly during COVID and making good progress, that have momentum, just kind of share what they're doing, provide some case studies. And to start things out, I'd just like to have each of the panelists introduce themselves here today. Bruce, if you'd like to go first.
Sure. Thanks, Richard, for having us on today. My name's Bruce. I'm a cash flow strategist out of St. Louis, Missouri. We also have offices in Scottsdale, Seattle, Nashville, and Austin, Texas. E3 Consultants Group is a full service, what we call family office model that has morphed into both multifamily and single family offices. And the concept that I think our listeners might understand is that not every investor is all of a sudden has enough assets to be their own family office. So we're kind of the transition between investors that really could benefit from some family office services by coordinating a variety of services, to then when they finally do build up enough of their assets to get into a multifamily office, and then finally to where they have enough assets to develop their own family office. So it's kind of a unique thing. A lot of people only think about the single family office, but we're a transition group that helps people in that process.
Okay, great. And Chris, you want to go next?
Sure. Thanks, Richard, for having me on. My name's Chris, the founder and CEO of. We are a mineral rights and oil and gas royalties investment firm. We currently have just under 30 million AUM. We're raising our fifth fund right now. Our previous four funds have all delivered double-digit annualized returns to our investors, and we're looking to continue our success. We think that right now is the time to buy. This is a very unique and niche asset class with inefficient market, a lot of information asymmetry, and we're just looking to scale and take advantage of a lot of deal flow that's out there right now. Extremely discounted assets in this environment, people looking for liquidity and willing to sell like never before. So look forward to talking with the rest of the group.
Great. Yeah, appreciate you being here. Joe, you want to go next?
How's everybody doing today? My name is Joe. I've got kind of two different things going on. I am the CEO and founder of. We are an ESG sustainable investment firm. We also do options trading. And I'm also one of the principals at Hercules Investments, which is an alternative investment firm. We're located in Los Angeles. Hercules has just been nominated for Alternative Asset Manager of the Year by Wealth Management Inc. or wealthmanagement.com. So we've been doing pretty well. We're really an alternative investment manager, and this is a fascinating market for these, all the volatility and all the things going on, all the uncertainty. So we monetize volatility for clients. We've been having great success doing that. This is the ideal market for that, and I'm happy to tell everybody what we're doing as we get into it.
Sure. Sounds great. First of all, I want to talk about customer relationship management software or other pieces of software you're using to build relationships with investors, to close more deals, to attract maybe co-GP partners, et cetera. Maybe we can go down the line and just see what software each of you are using to make progress. I know, Bruce, you've got a pretty big network. If you want to go first, is there something that you like to use, or do you just keep things via email or Excel?
No, that's a great question. We've tried several different softwares, but we actually have an engineer. Well, actually, we had two engineers on our staff that became financial advisors, and they developed their own spreadsheets for all this. And so we actually have an in-house one that keeps track of everything we're raising. And then that also helps show the tax advantages and then the income off of that going forward. So really it's an in-house thing that, because we in our model, we just haven't been very happy with anything out there in the industry, because most financial models do not take into consideration alternative investments. They do not know how to actually classify them as an asset and actually how to then show the income coming off of those and then the tax benefits of that. So Richard, we just developed our own.
Right. I know a lot of wealth management firms have to develop their own, and one large one that managed several $billion said that if they could have bought one off the shelf for $5 million, it would have been a great deal because they spent so much money developing their own. I think that a lot of people use a CRM like Salesforce or HubSpot just for developing relationships, but separate from that, wealth advisors really need some sort of aggregated reporting solution typically. And I know that Addepar is one that a lot of people use within the wealth management space. There's also one called Sage and eMoney Advisor, but the Addepar name has been coming up the most with our clients recently. Chris, do you use any CRM or client relationship development software?
No, we've tried, and we have three sets of customers in our business. We have our investors. We have our end buyers who, we're an aggregator of these assets, and we end up bundling them and flipping them to larger institutional buyers like pension funds, endowments, publicly traded companies, et cetera. And then we have the mineral rights owners, the individual owners of the smaller assets that we go and aggregate. So we had to build our own CRM. We worked with an awesome group called 3Dev that helped us build our own custom CRM that helps us manage this unique asset class and our investors, because when we go after investors, we also have to, depending where which fund they're invested in, and look at their allocation, and what their pro rata share of the entire fund is. So it was really complex. We didn't find anything that we liked that met our needs. So we were like, let's just make our own, and it's worked out well for us.
Right. Great. So for both of you have created custom solutions, which I guess is a takeaway in itself. Joe, what about yourself? Do you have a Salesforce type CRM or something that competes with that?
Yeah, we're kind of in transition on that. We were using Redtail, and we just moved over to HubSpot. And the jury is still out on that because, as you kind of alluded to, it does certain things, but not everything we really want it to do.
Sure.
So we're not sure we're going to stick with that, but we're actively looking for the right solution also. And it is tough to have one that really does everything for the reporting, keeping all the clients straight, getting the information out. So we'll keep you posted.
Yeah, it makes sense. We've given up hope on trying to find one that does everything, but we do love HubSpot. I've used Salesforce and Infusionsoft and MailChimp and Aweber. And the thing I love most about HubSpot is people can opt in from different regions, and where they opt in, what they click when they opt in, and then based on where their area code of their phone number is or the extension of their email address, HubSpot will scrape their website, find their address, and use all those criteria to tag somebody and self-sort them. So who's in your, Northeast region, your Midwest region. And that way when you're traveling or hosting an event or working on a deal in a certain region, you can be sorting people out automatically as your CRM is growing all the time. And so I really like how easy HubSpot, makes that. So happy to be helpful to anyone that has technical questions on that. Our team knows HubSpot real well. I'd like to have a couple of you answer this question now. What is the depth of your track record, and how did you raise capital enough times to build that early on when you couldn't rely upon just momentum and references and massive credibility? If you could each, or a couple of you, talk about your track record and those early on challenges and how you pushed through that. Because out of, it's like we have 310 people on here live right now, I would guess at least 150, 200 of those are, could be early on trying to make it through this process.
Well, Richard, early on, I think we focused a lot on real estate, which I think most people do. And the challenges for, if you recall, when I introduced myself, is people that are actually getting into more of a family office mindset is when you're trying to convince them to go away from the status quo. instead of just putting their money into normal equities, is that we always felt like we had to start out very, very small and prove ourselves to that, and show the returns mainly from a tax benefit prospect. And I think when you can show the tax benefit, we also have a tax department in-house, and we are with the Wealthability with Tom Wheelwright. We have 2 certified CPAs with him. When you can show people the tax benefits from pro formas from CPAs that people trust, then it's very easy then to move into a smaller offering. And then once they can see through a complete cycle of taxes, then the credibility is built up, and then they actually get a return from just the tax savings, which people forget about all the time. Everybody always wants just to see the external return, not the internal return from the tax savings. But if you can do that with your clients, then you earn some immediate credibility. And I think people forget that tax savings is actually a conservative way to actually build your wealth. And most people think, oh, I don't want to get into that because it's dangerous. We're going to throw up red flags. And actually, the tax code is filled with a bunch of incentives that are not going to, as long as you apply them correctly, are not going to throw up red flags.
Right. And the good news about people attracted or investors attracted by a smart tax structure is those are the investors that are qualified to be working with. If they're not caring about taxes and all they want is growth, it's because they're not earning more than $300,000 a year, or they're not worth more than $1 million or $2 million. So it attracts the right type of investor too, to be extra sharp on that. And then it also, what I found is that there's a self-reward by becoming smarter on that. Your own taxes will be managed better. Then you can add value to potential clients and also current clients. So you get like a triple ROI on getting sharper on the tax side of things. We're really digging into that more this year. So I appreciate you bringing that up. When I saw a question just come in from Richard Baum. How are you doing, Richard? I know we haven't seen each other in person for 9 months or so now, but if you want to switch from Salesforce to HubSpot, how easy is it? I found it to be very easy. If you have a ridiculously complex follow-up sequence and tagging mechanism in Salesforce, then it's going to be less easy. But switching over your Rolodex from one to the other is very simple. Chris, do you want to comment on building your track record? Like you have 30 or 40 million of assets now, building that up through your first 10, 15 million or 20 million. I mean, what advice or insights do you have on making it through that part?
My story, or Bellatorm story, is a very entrepreneurial story. We started this company in 2016. Before that, I worked in the same industry, and I got laid off at the end of 2015 when oil prices were crashing, but there was still a lot of opportunity in the space. And so I literally went out and did small deals with my own money. I'm talking $10,000 to $20,000. And luckily, during my MBA program at Rice, I was assigned a mentor, and his name's Barry Goldware. He doesn't mind if I use his name in public, but he founded Sun and Ski Sports, grew it from 1 store to about 40 stores nationwide. And so I will say I got lucky in the sense of my first investor. He said, hey, he asked me, how can I get in and invest in this asset class? And I said, well, I buy deals every time they come across my desk. I look at them. If they're good, I buy them. And as long as I think I can flip them for a profit. So he gave us 50 grand, and he, we set up a LLC, and there was no like official offering or Reg D exemption, no SEC type things. We just set up a partnership LLC. But then he went to his wealth manager after we did a few deals together, and it ballooned from there. So I will tell you, I do believe in luck, but, or when they say when preparation meets opportunity or whatever, we just kept executing our strategy, didn't deviate. And we grew our network from basically Barry Goldware to all his neighbors, wealth managers, advisors, friends and family, and some of our own. And so the biggest advice I would give are the challenges about, understanding SEC and FINRA regulations. I think Bruce and Joe are from, a wealth management kind of financial background, whereas I was not. And so I didn't even know what a PPM was in early 2017. And now we're about to launch our 5th private placement, and it's a 90-page document of just, invigorating reading that investors would love to read. But things like that, getting your securities attorneys, knowing how to structure your offering, knowing what's the right. I mean, there's so many challenges that happy to talk offline with anybody who's looking to raise capital about shortening their runway on understanding how to structure a partnership and what the general partner carried interest is versus the fees and the preferred returns and things like that you don't even know how to structure a deal when you're doing it your first or even second time, right? So we grew exponentially, literally from Barry's 50 grand. Our next one was a whopping 360K. That was with 4 people. And then the next one after that was 2.3 million. The next one after that was just under 5 million. And then the current one, we're at 28.7. So we did grow exponentially from 2017 till now. And we're expecting this one. I mean, we're raising during COVID right now, so a little bit challenging. But as you helped Richard to guide me to some good advisors and consultants, now we can have up to 2,000 investors. We're able to lower our minimum. So I think we'll hit the 20 million mark or maybe a little more on this offering.
Great. Yeah. And for those of you who weren't on the workshop yesterday, we went through a lot of different strategies and details related to raising capital for about 4 hours. We're going to have another workshop next month. But on your point there, Chris, we didn't have time to go over that yesterday, and I wish we would have, is that I see a lot of people out there getting momentum by having $10,000, $25,000, $50,000 minimums, especially if you're doing more than one offering per year. If you're doing, say, 3 offerings per year or some sort of rolling basis, like Bruce was talking about, if you serve somebody in Q4 and it's very tax efficient and they see their CPA bless it, everything goes through as planned, maybe by Q2 the next year, they're ready to go from 25K to 250K or $1 million. And I know some managers that have $100 million, $400 million of assets under management. They got great momentum by having the low minimums, and then they'd get referrals from those people that re-up, and they become $1 million investors, but they wanted to kick the tires first. And they almost see 10 or 25K as an extension of their due diligence. Like, let me just throw in a little bit of money here, see how they treat me, see their reporting, get to know their team. And many people get treated very nicely before they're an investor, but once they're an investor, you get to see how you really get treated. And so then you get more of a full experience. So it's interesting to see some people do that. So I'm glad we're able to, provide a suggestion there to help figure that out. And I also want to point out that through the Family Office Club, Chris was able to connect with an institutional investor that could be providing, tens of millions of dollars. It's not just going after tiny investors. It's not like he's excluding that capability. So I just want to point that out so people don't get the wrong idea. Joe, do you have any advice on building track record early on? I know you guys have pretty good momentum right now, but how did you get that momentum?
I think one of the keys is really being a thought leader. You have to be out there and you have to have your story. And it has to be fungible. It has to be something people can understand, something maybe that's a little different. James McDonald, who's our CEO, is constantly on Yahoo Radio, CNBC. He's in Fortune. And it's because he's a little different. He's an ex-football player. He was on Bloomberg television on February 6th, and he actually came out with a call. He said, you know what? Volatility is very low now. Volatility is going to spike. Here's the trade. And he did this on public television, and it was an incredible call. People who listen 10x their return. So things like that. If you're out there in front of people, you're giving your opinions, you're in the right place, you're on the serious business channels, people tend to listen. Now, of course, returns and performance don't hurt. But once again, you got to be a thought leader. People have to see you out there, know that you're a player, and, you build a following very quickly.
Great. Yeah. And Joe, I know that you were not on the workshop yesterday. At least I didn't see your name there. And we talked about thought leadership and building an investor funnel for a good 30 minutes. And I found that to be key. You know, it wasn't a planted question that I didn't know you were going to say that, but I found the same thing, that if you add consistent value, you know what your space is and where the gap is in the market and how you're going to add that value, then whether you put it out through a podcast or somewhere else, then, you know, you can build that following. And I know, Bruce, you've had a lot of success with that as well. I don't know if you want to comment on thought leadership you've done and what's worked and not worked for you guys.
Yeah, I am one of the co-founders of the Money Advantage podcast, and we've actually had Richard on a couple times. And our whole idea is not to get on the podcast and sell what we have in the pipeline, but just simply help business owners, which oftentimes need a family office, all the different services that are out there. And one of the things I think are going to set people apart going into the future is and Richard, you just alluded to this, is, you know, once you get somebody's money, a lot of times they don't get treated the same way as before they get it. And so the mantra used to be service, service, service. I think the mantra now should be services, services, services. In other words, what can you bring to the table for everybody to make their life easier? And so we sign off on every podcast is to help businesses and business owners and family offices, frankly, build a life and business that they love. And you do that when you can turn to a single point of person. What I often call myself is like a point guard, and somebody that you can just call and say, hey, I need this, I need this, I need this. I mean, Richard, I've done that with you, you know, recently. You know, we talked about taxes in Puerto Rico and so on and so forth. He said, oh, yes, some of the family office club members have done this. You quickly got me to that person. Well, that was a great service that I brought to one of our up and coming clients who's building a family office for him. So yes, I think putting yourself out there, and Joe, I agree. If you have something that's just a little bit different, then that's the way you set yourself apart.
Cool. Yeah. And I think, Chris, in your case, there's somewhat of a grit factor that maybe comes from being ex-military, where you just kind of grinded it out at the beginning and got these small deals done. And I see some people either not willing to do that, or they don't even think that that's needed. Like, some people come to the family office club, they've never raised capital before, and they're like, oh, we're a first time fund and we're going to raise 100 million on our first fund, or we're going to go raise 500 million. Or, you know, I got to go to A-Rod's house a couple years ago for a deal, and the deal was just a whopper of a deal, but the team behind it hadn't done any deals before. And it was almost, you know, it was not a good feeling. Like, I knew it wasn't realistic. It was a bad use of time, even though it was, you know, cool to meet somebody like that. And so, you know, I guess I want to make it really clear that people, like, when you started out, I mean, you're doing things for the long term. Obviously, the first couple of years, even though you succeeded in raising capital for those deals, it's not like you were making tons of money. It's all about the medium or the long term, right?
Oh, I would love to, you know, I'll try not to get on a soapbox about that, but even today, and you know this, Richard, you've invested with us. I pay myself $36,000 a year. That's my salary. I don't make money until we get our big exits, and I take very little. Even then, I reinvest into the business, and I think you have to be willing to do that, at least in an entrepreneurial type venture where, you know, I'm not a traditional fund manager, so to speak, or wealth manager. So I have to execute our business strategy, you know, and that first and foremost. And so the incentives are important for how I make money. And I found that a lot of our investors wanted to know, hey, Chris, how do you make money? And they love the fact that I only pay, the only reason I even pay myself $36K is because I want the medical benefits plan that I offer to my employees. And that's the minimum amount they'll let me pay myself. But you know, you mentioned the grit and all that in the military thing. I mean, I think, yes, it helps. You don't have to have served in the military, obviously, to have that resilience and grit and work ethic. But here at Bellatorum, you know, our entire team are veterans and prior military. It really helps us with execution, discipline, all those things. I think it also lends to the story, as you mentioned. So it helped us, while I didn't have a wealth of financial world experience. I had, several years of oil and gas experience in this niche asset class in this field that I'm still in. But I do think experience is important. I mean, to your point, I just talked to, I'm very active with the Rice MBA alumni network, and they have us talk and mentor, new current students. And I was talking to this MBA student yesterday from Rice, and he's like, same thing. I've got this idea. I'm going to raise $100 million, and we're going to these private equity firms, this and that. And I'm like, have you ever managed other people's money before, ever in your life? I mean, if you were a geologist or an engineer at Anadarko, great. You've got some technical expertise, but, to your point, Richard, I think investors want to feel that you know how to manage capital. There's things like investor relations, reporting, legal, all those things that you don't get exposure to when you're a technical expert in a given field. And so being willing to grind it out and learn and make some sacrifices during the early years, I think paid dividends in the long run.
Right. And I know you're managing up about $40 million up till now, but you might add another $20 million to that by Q1 next year, or maybe earlier. And you might be managing $80 million 12 months from now. But how many years did it take to get to 40 million? And now you might double in the next 12 to 18 months, but how many years did it take to get to 40?
So since May of 2017 until January of 2019. Now,
right.
Again, we had some really outsized returns that got people talking. And again, all of our existing investors are now, we started friends and family. Obviously, I mentioned Barry Goldware. Well, now we're friends of friends and family of family, but we're about 97 limited partners right now. And we'll probably get closer to 500 or so on this fund. Sure. May I just answer? There was a comment on the right, and I think they were asking me, Richard, about the 2,000 investors. If I could just hit
on for that, yeah.
So there's there's different SEC regulations, and you've got what's called a Regulation D 506B exemption, and then under that there's several paragraphs, and I don't remember which paragraph, but you've got short-term investments and long-term. And a longer term buy and hold strategy allows you to access more investors. And I'm not a lawyer, an SEC attorney or accountant, but what I've been advised is that a longer term lockup period and different, a little bit more of a patient capital structure allows us access to 2,000 investors. Now, it's also important to note, and you may have covered this yesterday, Richard, but that doesn't mean you can do what's called a general solicitation and do a mass blast of marketing and billboards and internet, social media, all that. You have to have existing relationships, and it's accredited investors only. If you do what's called the general solicitation, there's a big reporting requirement or burden, if you will, on you as the manager to verify that all of your investors are in fact accredited. And that involves getting, tax returns or wealth manager statements from wealth managers or accountants, verifying the net worth of the individual investing with you. So a lot of little nuance there that, I would warn folks who are out raising their first fund to be mindful of.
Right. Yeah. A lot of times I ask people, are you 506C registered to be able to do this? And they have no idea if they are. And many times they ask their attorney and they say, oh no, the attorney says we're not, but we probably should. And many times it just doesn't get brought up to people, even though their attorney was paid $30,000 to put together a PPM. They didn't bother to even have a conversation, or maybe the person forgot and the lawyer didn't want to confuse things and slow down the process of just getting the PPM done. But it's oftentimes not closely considered. We have a question from Hunter, which I'll address in just a second. But I wanted to hear from Joe about how your early momentum went. I mean, how small of investors or small of AUM did it start before things started to grow more quickly in your case?
Yeah, we've been growing fairly consistently, but with us, we deal mostly with accredited investors. But as we were just kind of talking about in the beginning, we took some friends and family and smaller accounts that, quite frankly, we wouldn't take today.
Right.
We've gotten to the point where now we can be more discriminating about the size of the account. So, but it really just kind of consistently grew. It wasn't geometric growth. Every month we're adding, you know, a percentage of assets, and it's great to see that. And the more exposure we have, you know, the more it continues to grow. Yesterday, for example, we did an educational webinar for Interactive Brokers. So we had access to their whole network around the world. And, you know, I've already gotten a lot of calls on things like that. So, yeah, not so much geometric with us, but constant growth. We're right now at 55 million, and we've been doing this for really since late last year, early this year.
Okay.
So
Okay.
I'd say it took us maybe the first 2 months to get to the 10 million mark.
Sure. Yeah. Well, that's not bad, actually. A lot of people don't get 10 million in the first year or two sometimes. So we had a question from Hunter on how to leverage somebody else's expertise to raise capital. And I'd like to answer that real quick myself about one point to be careful on, and then see if any of you have had a good success or pain in hiring a third-party capital raiser. But the question is about how to structure such a relationship. And just so everybody knows, in the United States at least, the only time someone can typically raise capital who's not on your team, unless they're licensed, typically it's only if it falls under some exclusion, like it's one investor buying the majority of something. There's a couple of SEC exclusions. Typically, though, they would need to be licensed through a broker-dealer, or just have to be very careful how you set that up. And some people try to kind of circumvent that by structuring something as a co-GP, or they're on the GP side so that they can act like they're really part of the team. But, you know, you have to be able to convince a regulator that that's genuine and accurate if you ever get investigated, and you could lose access maybe and get penalized for capital that you've raised or fees you earned. So it's something just to be careful on. But does anybody have an experience or an insight on hiring third-party capital raisers or third-party refers? Like in your case, Bruce, it might not be a capital raiser, it might be someone who's referring wealth management business over, or have you guys stayed away from that to do things internally? Yeah, Chris.
We've tried to stay away from that for the reasons that you were talking about with FINRA. It's you know, there's some things in our lives that we probably should push the envelope a little bit. There's other things in life that you don't want to try to you know, beat City Hall, and I think this is one of them that you should not, because there's enough capital out there if you do it correctly that is available. If you try to bring in a third party, and then suddenly if the third party is not, like you said, particularly if they're not licensed properly, and then all of a sudden they become disgruntled, then you open yourself up for, even if you have an agreement, then, you know, FINRA walks in and says, well, what is this agreement really? Are you doing a marketing agreement here? And this person isn't licensed, and so on and so forth. So I would just encourage everybody to try to stay away from it as much as possible. Right.
It's definitely something to be careful with. Chris, do you have any experience to share?
Absolutely. So to Bruce's point, you know, I think, you know, there are groups that are licensed to do this and have the correct qualifications so that you don't have to worry about it. And we've worked with groups like that. Here's my experience, and I'm not trying to disparage anybody in this business, but you know, you pay a retainer fee that you as the entrepreneur, the fund manager, you take all the risk, and the most of the capital raisers do not. They want a retainer fee plus a success fee, and we have not had success working with capital raisers. It has been my experience, and again, not to disparage anybody, but most of them want a quick, easy buck, and they don't take the time to learn the asset class or learn the strategy and go intelligently discuss your strategy or offering with their you know, potential investors. They all have a impressive Rolodex that they say they can contact, but when it comes down to it, you do all the work, you're taking all the meetings, and you know, quite frankly, they'll take 2 to 3 months collecting a retainer fee just to, you know, and then to get minimal traction. And so we have decided not to go with those, or only to work with groups that are only willing to use a success or get paid on a success fee. And I think going to individuals, while it's a longer road and you've got to get a bunch of smaller checks, the institutional route, which is usually with the capital raisers, the professional capital raisers, if you will, try to work in the institutional space. It's just a much longer road, and the guys want to do minimal work to get, to get the win.
Right. Unfortunately, capital raisers, placement agents, third-party marketers have a bad reputation because of that. There's obviously some good and bad ones out there, just like anything else in the world. But yeah, upfront retainers are the most scary. And then, very expensive retainers. If somebody has 5 retainers at $15,000 a month, how worried are they about raising the capital versus you? The reason they're able to do that is because everybody wants help raising capital. We have $20 billion in AUM firms reach out to us at the Family Office Club saying, what could we pay you to help us raise capital for our fund? And we say, we don't do that. We have our platform and our community and everything. But if a $20 billion in AUM firm with 120 team members needs help raising capital, everybody does. So they have their pick who to work with. So they don't care if you say no to their retainer. They've got 80 other people asking them every hour for help raising capital. There's never a shortage of that. We have a question from Brent here. He says, I've raised over $10 million in high net worth capital, looking to scale in the family office space. Richard, you talk about being flexible, working with family offices. Can you talk about this? I will ask the panelists after I make a comment of any flexible or creative deals that you're either negotiating now or have in the past, just to share what insights you have. In my case, I would think about this as going to an investor, and instead of only offering them an equity option, maybe also have in your mind, even if you don't want to confuse your materials and have 3 options in your materials, maybe have in your mind a income option or a debt option instead of just being a normal convertible note investor in an operating business. Maybe you could structure venture debt. Maybe you could structure something where they get 5% equity and a gross revenue royalty. And once they get 1.5 times their money back, their equity slot in the company goes down, or their equity warrants get reduced because they got their money off the table. That would be something to be open-minded about. If someone says, well, we care about income, or we don't want our money locked up for 10 years, to have such an option. Another option would be if somebody's going to come in as your seed or anchor investor or your largest investor, just know in the back of your mind, they might want to be on the board. They might want some level of control or insight, et cetera. So just being open-minded, if somebody could take the whole round that you need to do for your company or private equity fund or hedge fund, what could you give them to make that still a good win for you, but good for them as well? Anyone on the panel want to talk about any creative structures or negotiations that have been helpful in getting investors to the finish line and trying to get momentum?
I guess I'll take this one. Ours have been very creative to start.
Yeah.
We had friends and family. We didn't get to take any fees or run any expenses through the fund. We got a one-time management fee, which kind of like an acquisition fee, if you will. And then that was it, right? And so then we take only a split of the profits once profits were made. And so the financial accounting, the third-party administrator, the legal fees, all that we had to bear up front. So I don't know if you call that creative or just, the nature of being an inexperienced fund manager your first go around, but we were willing to do whatever it took and structure the deal whatever way our investors wanted at the onset. And it was painful. It was not advantageous to us, especially when I'd hear, other guys in the industry that had mineral rights funds and they're paying themselves $200,000 salary plus getting a, whatever percent management fee and running expenses through the fund. So, we're not there yet. And quite honestly, I don't know if we want to get there, but I will say that in our space, and I think the space that all of us are here when you deal with individual investors rather than institutional investors, it gives us the flexibility, to do that, to be, to be creative with our structures, because most institutional guys, in my experience, if they've got their out of the box, hey, 2 and 20, 8% pref, they're just going to give you an out of the box structure that maybe works for them, but does not work for somebody who's, investing in alternatives for the first time, or, even your given asset class. So I think staying nimble and flexible is key to raising capital with private, ultra high net worth individuals and family offices, at least in my limited experience.
Right. And we do have 15 more questions from people watching that we'll try to get to as many as we can here. We'll still finishing on time, but Joe or Bruce, do either of you want to comment on that one before we move on?
Yeah, I think flexibility is the key there, because we deal with, obviously you deal directly with investors, but we deal, with family offices. We deal with other RIA firms. We deal with estate planning attorneys, and everybody has different criteria, how they want to be compensated, what works for them to get them involved. So, I haven't found that we've been able to be consistent. It's like every situation we kind of look at differently, like, okay, what's going to work for and what's going to work for us. So yeah, flexibility is the absolute key.
Sure.
Richard, I would say that I would encourage Chris to stay on that track, because I've been in this space for about 13 years, and I've seen just in the last 10 years, I've seen a real shift to, sharing the profits at the end. And I think I'm on our due diligence committee, and we've made a commitment to look at the offerings that are structured in that way. And our clients, frankly, we tell them, and they agree with us, that, hey, we're willing to give up the potential overall profit of maybe 2, 3, 4, in some cases 5%, knowing that they have the skin in the game for this whole thing. And our clients agree with that 100%. So I think, Chris, the industry is going this way. I think fee compression on the RIA side is causing this to happen. And I don't think the people in Washington with FINRA and the SEC are, they're going to continue to think that fees are a bad thing. They don't understand that fees are actually what motivate people to put these deals together. Because they've never put a deal together in their lives. But I would encourage you to keep that structure, because I think that's where we're going down the line.
Yeah, and yesterday we talked about expediting the inevitable, and it's inevitable that more things will be performance fee. And when I was, to show you that I really believe that, and you should always look at someone's actions more than what they say on Zoom. Our investor platform, which is not for people raising capital, it's only for investors allocating, is called privateequity.com, and our only fee is a profit share. And if somebody does 2 deals or more with us and one deal loses money, our fees go to 0 across all deals and across years until they make their money back. And everyone else I see in the industry, you could lose money on one deal, they're still going to charge you full freight of fees on your other 2 deals with them. They don't care you lost money on your other deal. And so I see that as a future trend, is from hearing investors complain at our events is why we designed the fee structure to be that way. And that's really how we've gotten big momentum this year, is by having a very aligned structure. I've got a couple questions here. Bruce, you're connected to a lot of investors, and I've got a couple questions here about a first-time venture capital fund, a microcap company capital raise, some niche-related strategies. What advice would you have in getting the word out about something that is very niche focus to get the traction with investors who are typically your clients?
Yeah, I don't know. I'm going to stay away from the venture capital raise, because we do not like to play in that arena, because we're trying to hit singles and doubles and let the home runs, to other people. But what we do is actually try to network with people that are the CPAs, the attorneys that write these deals up. And it's just, I think Chris, hit it on it. It's just about grinding it out, meeting people, networking, over and over and over. These people that are trying to hit these home runs, and like you said in that meeting, that one day with A-Rod, and you're like, these people have never even done small deals before. So get with these people that have these attorneys, these CPAs, these other people that have done the funds before, offerings before, and just network with them over and over and over, and grind it out. Like Chris said, there's no magic. I say that all the time. There's no magic in all this.
Right. It's just a lot of consistency and focus and making sure you have something unique in the marketplace. So when people hear about it, they actually lean forward versus just having one more email in their inbox that they don't really want to respond to and really don't have to respond to. The burden's really on you to have something that's unique there. Mm-hmm. Let me see what other questions we have flowing in here. Let's see.
While you're looking, Richard, I'd like to add that your marketing materials, and this is something you harp on too, I believe, but they're important. I mean, knowing how to use PowerPoint and knowing the difference between ROI and IRR and how to convey that to potential investors. I mean, you got to put in the work there as well. And to echo what Bruce was saying about just grinding it out. I mean, that involves staying up late on messing with PowerPoint until you're pulling your hair out on how to get, whatever video or picture, put just in the right spot on a slide. And so it's the little things that matter too. Your presentation it's just like the old saying that, your first impression, if you can't meet somebody in person and shake their hand while you're wearing a nice suit jacket, your PowerPoint presentation better be top notch.
Right. Yeah. And a lot of people have way too long of a PowerPoint. We've reviewed 415 of those, and they're 40 to 90 pages long sometimes. And other times people don't have a teaser, which is really important, or their teaser will be a 3-page, looks like a letter that somebody wrote to a friend, and nobody's going to read all that text. Probably not even your own team members, unless they have equity in the firm, are not going to read all that text. And so people just need to keep in mind that no one's going to take you more seriously than you take yourself. We had a question here planned. I'd like to ask you, Joe, about what's the most painful or costly lesson that you have learned the hard way about raising capital or running an investment firm?
Okay. Running an investment firm, the first thing, make sure you hire the right people. A lot of times you want to get up and running and, people look okay. We've had some turnover just looking at people that they just weren't the right fit for the firm. So you really got to make sure you do a thorough interviewing process. The next one, this should be obvious. You got to control expenses. I don't care how much you make. If you don't control expenses, things aren't going to work out. And you better have people around you who know how to do that. You need experienced people. I mean, obviously with investment expertise, but you need people who know how to run a company. Because if you're a startup and you don't have somebody who can act as a chief operating officer, you're going to be in trouble. So these are the things, I mean, in a way it seems basic, but they're vital. You've got to control expenses. You got to have people know how to run a company, and you've got to be able to just make sure everything continues running smoothly, because it's so easy for a CEO to get spread so thin that maybe they're good at what they were doing, in this example, managing money, but they just can't do these 50 other things. So you need somebody you can hand off and say, hey, I'm focusing on this. You got to take care of that. So that would be my biggest advice.
Right. No, that's great. I'm glad you brought that up, because I saw a statistic once, I think it was from 2012, I saw this, but it said that over 50% of hedge fund failures were because of operational issues. Mm-hmm. Whether it's staff or getting their prime brokerage and administrators and custodians all set up, or regulatory headaches. A lot of firms just crumble under that. They might just be a trader. They just want to look at their screens all day, and that's what they imagine their life will be, but there's so many other things to manage, right? So I think that's a good point. We also have one more question here, and then we're going to give each of the panelists a chance to have a final comment or insight before we break for the day. If you start out raising capital and you learn things over time, what are you just learning right now that once fully implemented is really going to propel you to the next level of investor relations? Like, what are the latest strategies you're just starting to employ right now?
I think one of the things that maybe not exactly right now, but we've done very successfully is using webinars on a regular basis to keep people informed. You need to be in front of people and give them the opportunity to ask you questions about what you're doing. Newsletters are nice, but it's not the same thing. I mean, the one good thing that's come out of COVID is people realize that these Zoom meetings, they're really easy. So you need to use that as one of your main tools. So people have access to you. You're constantly in front of them, answering questions and getting information to them.
Sure. Great. I appreciate that. Chris, anything new you're using?
So I wouldn't say anything new that I'm using, but what I would say, you asked, part of your question was, anything that you've experienced as you're scaling or accessing more investors. And I'll say, especially in my experience, when you grow out of a small network of friends and family, there's got to be a point where not everybody can literally show up at your house on Saturday or text message you at midnight, and if you want to scale, it's a there's a lot of nuance to transitioning from, just a handful of folks that know you personally to getting outside. And so it's real easy to want to be all things to all people and please everybody as far as, the investor relations go. But at the end of the day, you're going to have to set some standard operating procedures around your investor relations and how you communicate. What I've found works is now, I used to just send out emails every time there was a new update and make myself available to everybody. They all have my cell phone. Now I've actually put in my offering documents, hey, investor relations will, there will be at least a monthly communication. You'll have access to your portal with your capital account information and the status. And other than that, we'll do quarterly Zoom calls, but don't call me unless you need redemption, you're getting divorced or on your deathbed, And so it sounds a little harsh, but if you want to focus on your strategy, and you want to be the most effective for your investors, you need to have your time free to go execute your strategy, and you'll quickly become beholden to your cell phone just doing investor relations all the time if you're not careful. So.
Right. I think with any growing company, like Joe said, you're running a business, you always have to be replacing yourself. Whatever you're doing, you have to figure out how can someone else do that. And I just focus, like we talked about yesterday on the workshop, unique ability, and just focus more and more on what you're most excellent at, even if that means someone else needs to be CEO or project manager. And, we're experiencing that right now in our investor division because there's too many investors signed up for me to get on the phone with them. And luckily, we have someone on our team who was at Northern Trust for 8 years. So he's putting 2 hours a day into helping me, and he's going to be full-time in that area soon. But you're very right about that. And I think, it's kind of what Joe was hinting at before. Bruce, what's new on your side that you're just implementing now?
Well, let me follow up and then I'll give it to you real quickly.
Sure.
Dan Sullivan is really good with a 10 times Mind Expander podcast. So he's all about unique ability. So if anybody wants to listen to that podcast, it's outstanding. I've been a Dan Sullivan disciple for about 12 years.
Nice.
I would say, let's go back to what Chris and I were talking about earlier and doing the little deals. Well, most high net worth investors don't have a lot of qualified money. But as I said earlier, we are actually kind of I don't mean this in a derogatory way, but we're kind of the halfway house between people that just have some money and then are becoming high net worth people. So they do have qualified money. Well, one of the things you can do between now and December 31st, if you can prove, and once again, I'm going to have to qualify this for a disclosure. I'm not a CPA and I'm not a lawyer, but you can remove money from qualified plans this year because of COVID, the CARES Act. And so if you're looking to raise capital, that would be one place to go look for some capital, even with high net worth people that maybe aren't 59 and a half yet. And they're like, they can't stand that they locked this money up. And so you could say, hey, did you know with the CARES Act, you can actually get to $100,000 of that, and you could actually pull it out, pay the taxes over 3 years, and actually put this into an investment that we're putting together. So I think that's a unique thing we have this year. Of course, you need to get all the legal and CPA advice for this. There's some provisions where you can pay it back over 3 years. We're encouraging our people to show them that's probably, go ahead and pay the dang taxes now and not worry about it, for the future. But I think that's a very unique thing because of the COVID CARES Act.
Right. And a lot of people raising capital also don't know that investors may feel like they either missed the run up on the stock market since March, or they can't believe, Apple's at 2 trillion and they think all this tech stuff is overheated perhaps, or they just don't know. And many of them don't know that they can take their IRA and make it a self-managed IRA or a solo 401k and actually invest in alternative investments, oil and gas, hedge funds, private equity through their IRA. And they don't know how to set that up, but millions of people have done that. A lot of people do that, and it unlocks capital. And so these self-managed IRA firms, they really want to work with people raising capital, because then they know that you're going to be telling your 200 investor prospects, like, hey, if you want to unlock your IRA, you don't have to do that just to get money into us. You could be putting 100K with us and 100K with 4 other firms. If you don't love the stock market so much that you want your entire retirement account to be publicly traded securities, then that's one way to unlock some of that capital. And you were mentioning taxes again, Bruce, made me remember that I've been talking to Chris and his CPA a little bit. It's just an example of one of the 100 ways you can get smarter on taxes, about hiring veterans or some people with classified different types of disabilities. You could be doing good, but also getting tax credits or saving a percentage on taxes. It's just another example of a way to add value to investors as you're working with them, and make it so that when we talk about adding value first, it can be one tool to add value first. You could introduce them to others. You can give them an insight or a strategy, a piece of thought leadership like Joe was talking about, explaining some complex, sophisticated situation, or helping them with a tax strategy, even if they don't need to invest with you to get that benefit of the tax strategy. Those are all ways to add value first, instead of just pitching first like most people do. So we just have a couple minutes left. I don't know if we want to do, Joe, if you'd like to make a quick comment or two, we'll just do a minute or minute and a half each down the line and then wrap it up.
Okay, well, raising capital is important, but once again, you got to be out there. Just give people access to you. And it kind of just building on this point, if you do a 1 hour per week webinar, you're actually saving yourself time. Because as Bruce and Chris were saying, you're not going to have these 100 phone calls in between. So I urge people to do that. Give people access to you, but then you limit it and say, okay, save it for next time. So that's an absolute best way to do it. What we're doing right now, in fact, today we're doing a webinar at 4 o'clock on volatility, because we really want people to understand that, as you were just saying, Richard, that market's overvalued right now. What do you do? How do you be safe? So we're going to explain to people how to do that. But anyone ever has any questions about anything about raising capital, they're welcome to contact me offline. I'm happy to talk to anybody about it.
Sure. Great. I appreciate you sharing that, Joe. And I agree with you. It's not about, it's going to take so much time to produce this thing. It's like you're saving yourself time by attracting investors, keeping investors updated, etc. Chris, what about yourself? Any last comments?
Yeah, I want to expound on what Joe was saying about building the team. And one thing that's crucial and kind of tied into the monetary sacrifices you make up front is also paying your team, right? A lot of people think you can give equity up and have a partner come in and work with you. And look, if it's your baby and you created it, I've experienced this the hard way. Nobody's going to care as much as you, even if you give them equity and they believe in the idea. Most people want a solid paycheck they can depend on, and medical and dental and vision benefits, and so we did that. We offered it very quickly, and at the expense of myself and my wife taking a salary, but it was worth it. I've got a fantastic team here, a very loyal, dedicated, hardworking team members that are mission oriented and just very professional. And I would say that taking care of your team, not to sound like some graduate school professor, MBA or leadership professor, but I mean, it's true. Like, take care of your team and they'll take care of you. And that requires sacrifice to yourself up front. So that would be my biggest piece of advice for building out a successful team.
Right. So delaying gratification in a few ways just to make things better over time is really a consistent theme, what we're talking about. And we do the same thing with our team. We offer full medical, dental benefits with no copay for their spouse and all their kids. And I think that is more than Starbucks offered, and they always brag about their great benefits. So at least we're paying more than baristas in terms of benefits. It's one thing to chalk up for us, I guess. But Bruce, any final comments from yourself?
Yeah, I think you know, when you're raising capital, but then we raise capital, but then we're also looking for deals for our family offices. And the most important thing is not the numbers. So many people focus on the numbers. The most important thing is to focus on the individuals. And it's never more evident than because of COVID, because the numbers are the numbers, and most of the time they're projections. Yes, you can look back on the historical, what they've done before, and so on and so forth. But you really got to be able to sit down and look the person in the eye, know what their management skills are, know what their critical thinking skills are, know what their leadership skills are. So when something like COVID happens, they're able to pivot in their offering and make sure that your client's money is protected. So I would say I would encourage everybody to stop looking at the numbers and actually start looking at the person themselves. And I'm not talking about whether they have an MBA from Harvard or how many millions of dollars of AUM they put in last. I'm talking about them as a true person, character type of person, because we messed up one time on that, and we looked at the numbers on an East Coast deal. In the trash service, we even kind of made fun of it. We're like, well, it's the East Coast trash. It's got to be the mafia involved with it. Well, I mean, the thing has gone south so badly, and there's people actually inside the organization suing each other, and that's the other last thing I'd like to say is somebody told me this a long time ago, and we forgot it on this offering, is don't do business with people who sue other people, because you're on that list eventually.
Right.
And I just get out of it right away. And we did not do a good enough job in the due diligence. And there's a lot of people in this deal that had already sued a lot of people, and it's turmoil. So that's kind of the last part, Richard, that I'd have to say.
Yeah, there's something I've always believed in as well. So I'm glad that you said it out loud. No one's ever said that at our events, but I think that's great. Well, thank you, panelists. Thank you, everyone, for watching here today. If you'd like to become a member of the Family Office Club and you're not already, just go to familyoffices.com/join. We have recorded 170 discussion panels, 14 full-length conferences. We have 5 different workshops on raising capital, review your pitch decks every quarter, and be happy to work with you guys more closely. If you're already a member, make sure you submit your materials for your quarterly review. So thank you again to the panelists, and thank you for everyone watching here today. Take care.
All right, thanks for having me.
Thank you.
Take care. Bye.